What's up, you guys? Welcome back to the Fire Grind. My name is Daniel, and on this channel we talk about stock market investing and personal finance. And today we're back in the studio, which is really just my kitchen table, but luckily we're back here, and this has just happened after I sold my condo. So if you're interested in hearing about my condo sale, let me know in the comments down below. An early thumbs up to my video would also be awesome, because today we're going to be going over my $20,000 Wealthsimple trade portfolio. Sorry about the animal noises in the back. We just got a cat and they're not exactly getting along, but hopefully they can get along during this video. So a quick summary of what's happening in my portfolio since the last portfolio update, which is around August 16th. So the total dividends that I've received in this portfolio was a total of $19.65. And the only purchase I've made in this portfolio since August 16th was in a company called Real Matters, or ticker symbol REAL. And I bought 12 shares of Real at $26.93 on September 1st. And I'll get into the reason why I bought into this company a little later on in this video. If we look at the statistics of this portfolio and just dating back to August 16th, on August 16th, the total deposits into this portfolio was $18,795. As of today, on September 8th, the total amount of deposits that I made into this portfolio was $19,290. So over that time period of August 16th to September 8th, I made a total deposit of $495. $400 of that was actually my own money from my bank account, while the remaining $95 actually came from referrals. Now, if we look at the total portfolio value as of August 16th, it was sitting around $18,930.29. And as of today, the portfolio sits around $19,730.66. So we can see that roughly over the course of 1 month, I've gained around $1,000 in this portfolio. And most of that is driven by technology stocks in my portfolio. Which I outlined in my previous video. This is a new strategy that I'm taking to this portfolio, investing in growth technology stocks. Now let's take a deeper dive into my portfolio and break down what's in my portfolio. So right now in my portfolio, I have 34% of it allocated to small cap technology stocks. These stocks include Absolute Software, Dye & Durham, Docebo, CloudMD, Drone Delivery Canada, Real Matters, as well as Well Health Technologies. So these stocks make up 34% of my portfolio, and if we look at each individual one, you can see that most of them are up fairly significantly, including CloudMD and Well Health Technologies. One last stock I forgot here was Lightspeed as well. And since the early days of my channel, I've been investing in Lightspeed very slowly, and so far that has paid off as well. And if you're curious why I decided to invest more into Canadian small cap technology stocks, you should check out my previous video, as I give 4 different reasons why I'm choosing this strategy. The main reason why I'm investing into small cap technology stocks is because if we look at the success of US technology companies growing to be multi-billion-dollar companies, I think Canada's technology stocks are going to also do the same thing. Right now, a lot of Canadian technology companies are sitting somewhere between the $1 billion mark and the $4 billion mark. However, once they grow to a mid-cap stock or even a large cap stock, this is where things get really interesting. They get interesting because larger hedge funds are able to invest in these companies when they become mid-cap or large-cap companies. As small-cap technology stocks, large hedge funds usually don't put any capital into these companies. But once a large hedge fund starts deploying capital into a stock, they usually deploy somewhere between $100 million, and that is a stock price moving investment right there. Investors like you and I investing $1,000 or even $100 at a time is not really going to move the stock, but when a big hedge fund comes in and buys over multiple days or even months, investing a total of $1 billion into a company, that's really going to move a company's stock. So my plan is, if I can get in before these large hedge funds, I can ride the wave up. And yes, some of these companies may not even make it to that point because they are still somewhat risky. However, I'm spreading out my risk by investing in multiple of these companies, and I believe one of these, at least one of these, if not all of them, will play out in the long term. The key thing for me when investing in Canadian technology stocks is not to just throw money blindly into them, but it's to look at the business, understand what they're selling, and understand why customers are going to buy their products. And that's how I arrived at picking every single one of these stocks, and most of them I've talked about in my previous videos. So if you'd like to know more about them, let me know in the comments down below and I will link you those videos. Now, aside from the growth technology stocks, I also have other stocks which are considered growth stocks but not in the technology sector. and this makes up 34% of my portfolio as well. These stocks include Ats Automation, Aritzia, Canada Goose, Go Easy, Storage Vault Canada, and Waste Connections. Most of these businesses I've talked about on my channel before, so if you've been following my journey, you'll know why I'm invested in each one of them. One of these, however, I've not really talked about, and this is Ats Automation. In this stock, I did mention in a previous video, I'm waiting to sell this stock, however, it hasn't hit my price target yet. And the reason why I'm selling ATS is because it's a relatively small position, and I want to get out of it at around the $22 mark, so I'm waiting for the price to go up to then. Until then, I'll be holding the stock as I don't see any risk with this company. They have some major contracts coming up, but for me, it's not really my cup of tea, and that's why I'm choosing to let it go once it hits $22. As for the other stocks like Aritzia and Canada Goose, these are two retail plays that I really like that are Canadian companies. They have strong brand recognition all over the world, and they're continuing to grow their retail presence. Despite COVID happening here, I think that once COVID pans out and everything gets back to normal or whatever the new normal is, these companies will only benefit because a lot of the weaker players in the market will have already been bankrupt, and therefore Aritzia and Canada Goose can come in and take out more market share. As for Go Easy, this is a high-risk loan company where they give loans to people who don't exactly have the best credit. However, they charge absurd percentages of interest on their loans. So Go Easy makes their money off of high-interest loans, with quite a few of them probably failing. But the reason why I invested in Go Easy in the first place is because they have proved time and time again, quarter over quarter, that they're able to turn a profit and grow their business at impressive numbers. As for Storage Vault Canada, this is a growing storage company that's continuing to expand throughout Canada through acquisition and mergers. Storage Vault Canada has been growing its arsenal of storage facilities for the past 3 or 4 years. If you look at the stock chart of this company, it's been on fire in the past 2 to 3 years. However, in the recent year, it's slowed down and sort of plateaued for a year or so. And for this reason, I think it's a good time for me to continue averaging into my position, as the price is actually right around my cost basis of $3.28. It's actually a little bit below the stock price today. So I do plan to invest future funds into Storage Vault Canada as long as it stays somewhere around the $2.20 mark or below. Lastly, Waste Connections, I actually mentioned in my previous videos on 3 stocks to buy for September. So if you're interested in hearing my reason why I think this stock is a great buy right now, you should go check out that video right up here or down in the description down below. The second last portion of my portfolio is dividend stocks. And I've actually been trimming out dividend stocks from my portfolio because I'm switching over from an income-based portfolio over to higher growth. The reason is I'm still fairly young right now and I'm looking for higher returns, and I'm willing to risk a bit more because my time horizon is somewhere between 30 to 40 years. As someone who's close to retiring, if you're in that boat, you should probably consider getting out of growth stocks and putting more money into dividend stocks, because dividend stocks tend to fluctuate less, as well as they give you a little bit of stability and income every month or every quarter. So the dividend stocks in my portfolio make up around 29.8% of the portfolio right now. These companies include AltaGas, Algonquin Power Corp, Canadian Apartment Rentals, Chartwell Retirement Residences, Fortis Energy, Hydro One, Manulife, Parkland Corp, Ryokan, Sienna Senior Living, and Slate Office REIT. I'm not going to go into detail for each of these stocks, however, a few things to note is that I'm planning to sell out of AltaGas soon, and I really bought into it for the high juicy dividend, but in the long term, I don't really know too much about the gas industry, therefore I'm getting out of this once the price is right. For now, I'm willing to stay in it and collect the dividend, but I'm waiting for the price to go above my cost basis. Another stock that I'm looking to sell out of is Slate Office. And the reason why I bought into this was at the beginning of this portfolio, again, I saw this company as a juicy dividend. They just dropped the dividend from 12% down to 6%, which caused the stock to sell off significantly. I figure that I can get in at these lower prices and watch the stock ride up as investors buy back into the stock, because I thought it was a bit of an overreaction that it sold off so quickly. However, that was not the case, and this thesis proved wrong, and the stock continued to drop, and today I'm still down around 20 to 30% on this position. I plan to hold this for a little bit longer, but I am looking for an exit point for the stock, and I'm waiting for the right time for this. The 2 favorite stocks that I have here in my dividend portfolio really are Parkland Corp, because they're taking over the funeral industry, and there's only 3 things certain in life: life, death, and taxes. And because Parkland Corp is in the business of making money off of when people die, as morbid as that sounds. They're going to continue to have a strong business going forward, especially with baby boomers hitting that age where they're going to be looking for funeral home arrangements one day or another. Rest in peace. I'm also fairly confident in my Ryokan investment because I looked into the company and they're able to pay the dividend for the next 2 years. As well as Ryokan owns some pretty impressive properties that are more high-end, and I think that they're going to be a little bit more safe from the whole effects of this pandemic versus some of the lower-end retail locations. With higher-end retail locations, I don't think these stores are going to give up the real estate. They still like the physical presence because a lot of their customers go shopping more for enjoyment rather than for need to shop. And lastly, the cash position in my portfolio right now sits at around 2.2% or $451.78. And if you guys have been following me since the beginning of my journey, you'll know that I've been looking to raise my cash position to around 10% of my portfolio as a minimum. However, that has changed a bit in my mind because I'm doing a monthly deposit into this portfolio and I also have cash on the sideline in my EQ bank. So I don't plan to hold the 10% cash in my Wealthsimple trade portfolio. I plan to hold my cash in an interest-bearing account like EQ Bank, which is paying around 1.7% right now. So cash is better off there, and if you're interested in signing up for EQ Bank, there's a link down below in the description which you can sign up today, and you can earn $20 if you deposit $100 into your account. So now we're going to talk about Real Matters and why I purchased the stock. So the first thing is that I've been hearing about Real Matters in the comments for quite a while, ever since it hit the $14 mark, and since then it's run up all the way to around $32, but had a pullback to around $26 when I made my purchase. So the reason why I purchased Real Matters is because it's a great stock in the Canadian technology sector, which is in the industry of mortgages. And if you guys haven't been paying attention to the real estate market in Canada, even after the pandemic, it's still very hot and they had record sales in August for some areas in Canada like Toronto. So for this reason, I'm buying into Real Matters, banking on the Canadian real estate market continuing to be hot going forward in the future. And I think the reason why Canadian real estate market is hot right now is because of such low interest rates. And if these low interest rates are here to stay, which they likely are, then the real estate market will continue to pick up even going forward in the next couple of years. And this will only benefit Real Matters because they make money when more people apply for mortgages. I may do a deeper dive into Real Matters in the future if you guys are interested. So that was a fairly brief, high-level overview about the company as to why I'm investing in it. So if you want to know more about that, let me know in the comments down below. Lastly, I'm going to close off this video with my thoughts on going forward and what I'm going to do with this portfolio. So I've already mentioned a few stocks that I'm looking to buy and a few stocks that I'm looking to sell. One last thing is I'm looking to also continue to add to my Well Health Technologies position because I do believe in this company in the long term. However, the stock has shot up fairly significantly recently and I'm waiting for some sort of pullback to buy into the stock. I think right now there's still a lot more risk to buy into the stock at the $6 level, and therefore I'm waiting for some more consolidation to see if I can time a better entry point. I know that this could be considered a bit of a gamble to you guys who are in Well Health right now and buying at the $6 level, but for me, I'm not looking to rush into Well Health and purchase it at the next moment. I do believe that I could probably find prices that are a little bit lower from here, so I'm waiting for that, and if I do miss it, then that's a lesson learned for me, and I won't cry over it and I'll just move on. There's always going to be great companies out there to invest in, and if you miss one, there's always going to be another. I'm not going to rush into a stock because it's hot. I'm going to wait for the right point for me where it makes sense to buy into the company before I make that purchase. If you guys enjoyed this video, please smash the thumbs up button once again if you haven't done so already. Leave any comments down below if you have questions about my portfolio or any other stocks that you think that I should add to this portfolio. As always, subscribe and hit that notification bell if you're new here or if you're a returning viewer and haven't yet subscribed to my channel. Keep up the grind and have a great day.